Local stories, local voices. We're localwebradio.fm.
Welcome to Sound Investing with Byron Striloff, Senior Investment Advisor at CIBC Wood Gundy, and recognized by Vancouver Magazine in its selection of top wealth makers in Vancouver for 2013. And now, here's your host.
Well, yes, this is your host, Erik Reynolds, and I'm here with Byron Striloff, Senior Investment Advisor at CIBC Wood Gundy. And today we're talking with Byron about investment portfolios, including a discussion about securities, the problem with being over-diversified, and some tips when investing in mutual funds. Now, before Byron joins us, just a reminder that if you have questions or require assistance, you can reach Byron at 604-535-3700. Again, that's 604-535-3700. Well, Byron, it's great to have you joining the call again today.
I'm glad to be here, Erik.
Well, hey, we've got a lot of questions. It's a really interesting topic, so I'm going to go straight into it. Let me ask you this. So today I recognize that we are talking about over-concentration of securities and why that's not good. So Byron, what exactly is over-concentration?
Well, I think Peter Lynch, who ran one of the most successful mutual funds in history called the Magellan Fund out of the United States, he coined a phrase in his book, One Up on Wall Street, where he called over-diversification de-worsification. And that's become a buzzword used to describe inefficient diversification as it relates to your entire portfolio. So a good analogy would be like a large corporate conglomerate owning too many investments that can confuse you, increase your investment cost, add layers of required due diligence, and can lead to below average risk-adjusted returns. Today we call it over-concentrations, which really is too many positions in a managed money investment portfolio.
Now, diversification, Byron, that's a great term. Now, I'm interested, though, in how concentration works against investors, but before you explain that, just cover the main points about the benefits to investors of managed money.
Well, the first ones that come to mind, I guess number one actually is professionally managed. A professional will decide the best risk of investments and will manage it all on behalf of the fund's investors so that as an individual you don't have to worry about the work or the worry. Number two, I think, would be cost. It's always cheaper for an institution to trade on behalf of many investors than just by yourself, and they can trade at wholesale costs on big positions, and they do have access to issues that as individuals we just cannot get. So basically they have first pick of issues that come to market. And last would be the diversification, which is a broad range of investments. So by investing in a number of different assets through a mutual fund, you're minimizing your risk because your money is no longer dependent on the performance of a single investment.
So, Byron, then what's the problem, though, with being over-diversified?
Well, diversification amongst many securities is desirable, of course, because it eliminates the significant risk associated with each individual business. But your return is an average for all the businesses. In other words, a market rate of return for that particular category. So mutual funds that are broadly invested are already diversified, and even sector funds that concentrate on one industry or one country offer diversification among businesses in that industry. So diversification is an effective investment strategy, but like anything, it's possible to have too much of a good thing. Owning too many mutual funds can work against your goals. And that's why it's important for us to have a clear perspective on all of our clients' holdings, including those managed through accounts with their employers or their insurance companies or even held independently. What we want to do is avoid duplication, or what we call ineffective diversification. So there are some possible negative circumstances for over-diversification.
Well, then let's talk about that, some of those negative consequences. What would be some negative consequences of over-diversification?
First of all, you can have diluted return potential. Owning one high-quality Canadian equity fund can lead to a better return potential than owning 3 or 4 funds. You may have too much overlap. It lessens your chances of beating the indices, and it'll reduce the impact that any one fund can have on an overall portfolio performance. It's like having too many securities in a mutual fund. You could have 3 or 4 or 5 that double, and you wouldn't even be able to tell it. Increased complication is another concern. Too many mutual funds make it more difficult to track and monitor your portfolio. So for anybody, it's far easier to manage 4 or 5 funds than 15. You can also end up working against your goals. Too often there's confusion over multiple fund holdings, and that may leave you with funds that don't suit your goals. If the primary objective is income, do you really need a foreign equity fund? Or if you invest in a balanced fund or a balanced mandate, do you really need to select individual equity and bond funds around it? And often even funds with similar names could be working at cross purposes because they often will have different investment strategies, different goals, and totally different securities that they manage. And I think lastly is always a big one, unnecessary fees. Funds that hold similar investments may have different management expense ratios. So holding a single like lower ratio fund with the same objectives would increase returns. So we want to talk to our clients about all their holdings. The first thing we want to do is to help pare down the portfolio for individuals so that they have a few well-chosen funds that will provide them with the diversification they need, which is to meet their investment objectives. So if you invest roughly equal amounts in a large number of mutual funds, no one fund will have much impact on your total performance, and your total performance will be a function of all the holdings of all your funds.
Well, Byron, I've got a handful more questions, but I can see we're up against a break. So let's go ahead and pause here, and we'll be right back with Byron Striloff, Senior Investment Advisor at CIBC Wood Gundy. And when we return, we'll be discussing investments and risk management. We'll be right back.
More Sound Investing with Byron Striloff after this.
Buying or selling a home on the Semiahmoo Peninsula? Catch up on local market conditions on This Week in Real Estate with Lance and Connie Marples from Sutton West Coast Realty on localwebradio.fm.
If you're struggling with a dental or oral health issue, be sure to catch the Healthy Smiles Oral Health Show with Dr. Norm Ickert on the Health Channel on localwebradio.fm.
Shopping for the lowest mortgage rate? Looking to refinance?
Catch the Mortgage Newscast with Jared Dreyer
On the Business Channel.
on localwebradio.fm.
It's now time for more Sound Investing with Byron Striloff, Senior Investment Advisor at CIBC Wood Gundy.
Well, all right, we're back with Byron Striloff, and we're discussing diversifying your portfolio. Now, Byron, given this limitation to the benefits of diversification, why do so many fund managers own far more stocks than are necessary to obtain optimal diversification?
Well, I think the answer is that most fund managers perceive the biggest threat to their job, which is not whether they lose investors' money, but whether they differ from their peers, other managers. And I found that if they own so many stocks that they hug the index, they actually feel like they cannot be criticized. So I think this comes under money manager psychology. Fund managers often have one eye on the market, one eye on the indexes, and one eye on other managers competing in the same space. So, from my point of view, the main focus of investing may not perhaps be receiving all of the attention it's due. With the stock market up pretty strong in general last year, money managers can't afford to fall too far behind their peer group or the indices. So as a result, many managers, they end up acting like lemmings, and they will follow each other off the cliff rather than risk being different and thinking independently. And that's a big problem in Canada, where we only have so many large and liquid stocks. Another problem is that managers are basically compensated on how they perform relative to their benchmark. And sometimes the bonus is based on being in the top quarter performance or the top decile of all the other managers. So there's ample incentive to be more of a follower rather than having both eyes on the ball. Now, and in my opinion, that would be quality research and picking the best securities. Now, I believe that many fund managers' returns are impaired by these attitudes, and I do know from experience that some of the best long-term performance has come from managers that think outside the box.
Well, Byron, as an investor, these are some issues I never would have considered before. Now, are there any other types of issues we should be worried about regarding portfolio managers?
Well, Eric, I think a big one is that I mentioned it in the last answer that investors should be on the lookout for index huggers. And what this is, these are actively managed funds that so closely resemble their index benchmarks that they really offer no chance at top quartile returns. Investors wind up what is effectively an index fund with a fee that can be significantly higher. Now, unfortunately, this practice is rampant in Canada because our market has so few large, frequently traded stocks. And I remember just recently, I read a study from the University of Notre Dame, and they recently analyzed our country's largest mutual funds and found only 10% were highly active or highly managed. 30% were moderately active, and actually 60% simply mirrored their index benchmark. So I saw that the situation is very different in the U.S., where managers have far more investment choices. The study found only 15% of actively managed U.S. funds were index huggers. So when it comes to picking mutual funds or managed money products, management selection becomes a very important criteria. Because if you're paying the average of 2.5% and maybe 2.75% for a Canadian equity fund, and it just holds the big banks and energy producers that dominate our index, your chance of above average performance, consistently getting above average returns, is virtually zero. And that's why investors who want the potential for index-beating returns should look for funds that are really, truly actively managed.
Well, Byron, I know we're coming up to the end of this episode, but let me ask you this. What is one quick tip that investors should be careful of when investing in mutual funds or managed money investments?
Well, I'll tell you, I think one of the big ones is income taxes. And to that point, I'm going to talk about phantom income. That's another big concern. So my advice to investors is always consider the tax implications of your funds. Many funds turn over 70, 80, or even 100% of their portfolios annually. Now, this can make for a lot more short-term gains in a rising market, especially. So in addition, trading costs are greatly increased by this large turnover, and trading costs are not included in the fund expense ratios. So the other one that's very important is that the potential of phantom gains, and I'll try to explain how that works. Mutual funds can make capital gains distributions, which are often done towards the year end, October, November, and even December. So say an investor puts money in a fund on the beginning of October, and let's pick on Microsoft, and it's trading at $36 a share when he gets into the fund. Now, if the fund has owned the stock for a few years, and let's give that a cost base of $21 per share, if at the end of October the manager decides to sell Microsoft at the market price of, say, $35 per share, despite having only been in the fund for 2 weeks, the new investor will get a $14 per share capital gain, which is taxable to him even